Sam. Sam, would you do me a favor? Would you stand up, and then turn around and walk about 4 paces to your left. I'd like you to see Sam in front of that portrait of him hanging on. I don't know how that happened, but it's pretty cool to be here in Buffalo, and I want to really thank Ken and thank Sam for pulling this event together. I'm going to introduce the middle market to you. I'm going to throw a lot of numbers at you. It's going to be a little bit of drinking from a fire hose, but part of my point is you didn't even know that there was a big tank with all that water and all that fire hose and all that stuff about the middle market, because they are, I'm going to try to demonstrate to you, the sort of the forgotten heroes of American business. And we in this room and we in other rooms around the country can do something about it, and it's pretty important to do. I come to Buffalo, my wife's father's family, actually, my wife still owns what's left of the farm near Gasport, New York, between Gasport and Lockport, up there on the Ridge Road in a farmhouse that was built from handmade bricks in 1812. So I know a little bit about the upstate region, and I know a little bit about, and particularly about the western New York region, mostly through my wife, and also through the stories of my late father-in-law, who was always telling about, the tenants and what lousy tenants they were and how difficult, all those kinds of issues. But it's really great to be here, and also great to be here in a city that many of you know, but I didn't know until I saw it in a John Ware play. Was at one point in the 1930s the fourth largest city in the United States, and Buffalo is, let's hope that Buffalo is like the next Detroit, and I mean it in the positive sense, the next place where you can actually see a revival to the extraordinary achievements of its past and the glory, oh my God, what a cool place this is, and the opportunities of its future. And if that's going to happen, it's going to happen because of companies in the middle. Now, the National Center for the Middle Market is starting on its 4th year. We were founded as a partnership with GE Capital, so I can thank another sponsor, and they are our main man here in terms of sponsorship, at the Fisher College of Business at the Ohio State University. And it was invented, it was conceived to try to shed light on the middle third of the U.S. economy. We define the middle market as being those companies that have revenues between $10 million and $1 billion a year, which is 2 orders of magnitude, but it's the middle third. There's about a third in private sector GDP that's in smaller companies, about a third that's in larger companies. There's about a third of employment that's in smaller, about a third in larger. And the middle, like the middle child, is sitting there sometimes often forgotten. They're in every sector of the economy, from financial services to energy to logistics to consumer packaged goods. There are names you know. Orbitz is a middle market company. Callaway Golf is a middle market company. Elmer's Glue, Tootsie Roll, a whole lot of local ice cream and some of the larger craft breweries. And then there are a lot of companies you've never heard of. And then there's some other funny companies, like the New York Yankees. Every professional sports team is a middle market company. The NFL may have more than $1 billion in revenue, but the individual teams do not. So there's a whole lot of them. 85% of them are private. Within the private group, about a third are family businesses, about a third have some sort of private equity investment, and a third are other. And those may be the sole proprietorships or partnerships or some other limited liability corporations or some other form of ownership. They account for about $10 trillion in annual revenue, and they are the biggest job creators in the United States. And we'll talk about that in a second. We were created, as I said, to do 3 things to try to shed light on this part of the economy. One, to sort of provide data. They're private companies. Nobody knows anything, right? Chief economists at Morgan Stanley can't track what's going on in the middle market. There are no stock market stories. There's very little stuff, very little research into the middle market itself. We also try to provide expertise and outreach, events like this, and partnerships with business development groups, such as the one we have with Ken and with various other organizations around the country. We do a lot of executive training. We give grants for academic research. The 2 things academics need to do work, and they need data and a grant. And so we try to provide the data, and we also try to provide the grant. A little bit about New York's middle market, which you referred to. There are about 10,000 middle market companies in New York. 4 million jobs. And as you can see, it's divided among all the industries in various ways, shape, and form. And that's, You know, New York, as you would expect, is a little more heavily weighted to financial services than Ohio. It is a little less weighted to manufacturing than some of the others. More than $500 billion, half $1 trillion in top-line revenue from the middle market companies in the United States, and yet try to get some attention for who these companies are and where they are. I'll talk a little bit more about that. One of the things we do is every quarter we do a pulse check. If this is the heart of the economy, we want to find out how the heart is doing. We do a middle market indicator survey, and I'm going to give you a preview of stuff that is actually not going to be released until next week. So if anybody talks to you now and next week, you will be shot, or we will have actually the Ohio State front line come and find you. And I'm going to show you a little bit about this stuff. These are data as of the middle of December. So it's really a first look at 2014 in the middle market. Top line headlines there. Strong top line growth, year-on-year employment growth, doubled from the year before. Increasing confidence in both local and national economies. Increasing wariness about the global economy with some pretty good justification. And a lot of appetite for expansion and innovation. The strongest appetite for expansion that we've seen in the 3 years that we've been tracking the middle market indicator. We surveyed, as I said, 1,000 companies chosen to be representative in terms of size, in terms of industry, in terms of geography. And here's the top line. 7.2% top line revenue growth between this year and last, which compares to 4.9% for the S&P 500. So the middle market has really been leading the charge in the recovery of the United States. The projected growth, this is a sort of an interesting number. Middle market executives they tend to underpromise and overdeliver. So they had 7.2% growth last year. They say next year's going to be a great year, we're going to deliver 6%. They have every time they have outperformed the number they've given us. That 6% number is actually the most robust number we've seen from them. Look at the employment growth. First of all, the employment growth in the middle market, 5% addition to payroll year on year, compared to 2.2% for small business, 2.2% for large business. One of the interesting things about small businesses, small businesses create a lot of jobs. They also kill a lot of jobs because the life expectancy of small businesses is sort of like that of fruit flies. The average middle market company, the median age of a middle market company is 31. So they're not startups. They've been around for a while. And so you tend to get sustained job growth, and you get some of those big growing companies. You also get some lifestyle companies that don't grow a lot, but you get the big growers. And again, the projected employment growth rate of 4% is the highest number we've ever seen. So these are really good numbers. The number that sort of most delights me in this is the 68%. Every quarter, we say, if you had an extra buck, would you invest it or stick it under the mattress? And for the first 3 years, almost, the first 11 quarters, mostly about 62, 63% have said they'd invest, and 38% saying we're falling asleep easier when they have the mattress. And this number has popped up to 68%. Now, middle market companies are financially conservative. Right? They don't have easy access to capital in public debt markets. They're sort of like a camel. They got to carry their own water into the desert. So they do want to hold a lot. They tend to want to hold a lot of cash. But this appetite for investment suggests to me that the middle market is finally exhaling after the Great Recession and is finally getting confidence that the recovery is robust enough and continue enough, and they've started opening the purse strings both on investment and hiring. So here is just some stuff that, as I said, I come from Ohio State, and so red is good. And so what I've done here is these are basically revenue growth over the 3 years we've been tracking it, and the New York middle market is picked out in red here. And you'll see it's basically mostly tracking the rest of the middle market, and the S&P 500 lingering behind. That's on revenue growth, employment growth. You see a real interesting pop in the New York middle market but again, you see the revenue growth kicking along much higher with the middle market or the job growth much higher with the middle market than you do with the small businesses or the large businesses. So and then if you look at questions about confidence, like how's business going to be, this is confidence in the global economy, and as you can see, the national middle market and the New York middle market are both sort of saying, I don't like what's going on in Europe, I don't like what's going on in China. Middle market companies tend to be local champions. They tend to be very much part of their local or regional market. Only about 40% of them are active exporters, for example. So their confidence in the national economy is much stronger. It's an economy they know, and it has continued to steadily rise. And their confidence in the local economy, you notice this is kind of interesting. It's rather surprising to me because given the sort of general cynicism of us New Yorkers, that the New York middle market seems to basically think New York is about as good as other people in the rest of the middle market think their middle market is. So a little bit right now, a little bit of a dip, but generally it seems to be tracking national numbers in terms of here's the investment number, and you can see that number sort of ticking up from the 60s and then sort of popping up. I guess at one point in the early comeback from the recession, there was a jump, but that's moving to what may sustain at a higher number. It'll be interesting to see whether that sustains over the next couple of quarters. Top 5 business challenges, because who is a businessman if he doesn't complain about how business is cost of healthcare. Everybody has a problem with the cost of healthcare, cost of doing business, ability to maintain margins is more of an issue in New York than elsewhere, but roughly the same thing. And as we were talking about in an earlier section today, talent issues are starting to show up big across the entire middle market, and that's partly because we're hiring again, and we're looking around, where's the skilled workforce, or where are the skilled managers that we need, or the talented managers that we need, where have we got the NBA players we need to play in our high school gym. So that's basically the picture of the middle market in New York. With that, I'm going to pause. We're going to rearrange the chairs to bring our panel up here. We can talk a little bit more about these data, and we'll also have, I think we have copies of this presentation, or not, we can certainly get it for you. And you can find the middle market indicator will be released next week with lots more data than the headlines that I've shown you. So if you want to join it. The bottom line is, these guys matter. And these guys tend not to get the attention because they're wrong. Business development groups tend to focus on the Hail Mary pass of attracting a Fortune 500 company, or on startups and small businesses, and they tend to forget the guy with the factory down at the end of the road who's employed 250 people for a while and it's just hired another 50 or just hired another 25 or whatever it is, which is where a lot of the growth is. And bringing attention to this important sector is part of what I'm all about, part of what the National Center for the Middle Market is all about, and I hope I tried to suggest to you it's part of what competitiveness and economic success for this region and for the country are all about. So with that, guys, come on up. We'll spread the chairs out a little bit, and we're going to have a discussion about some of the issues. We're going to take this from data to stories and stuff you can really work with. I'm going to ask, their bios are also in the material you've got, really impressive bios. What we're going to really want to get to is some really interesting stories. And I'm going to basically start, and just we'll move down the panel. What I'm asking each of the three to do is begin by telling a little bit about his business and some sort of key turning point in that business, and then we're going to come back and go around again and talk about issues that they feel passionately about that are crucial for the success and growth of mid-sized companies and things that they ought to do about it. So, take it away.
My name is Dan Murray, Chief Marketing and Underwriting Officer. Marketing does not mean I'm in charge of advertising. Doesn't mean I'm in charge of soliciting all the new shoe stores in Niagara Falls, New York. Marketing and the insurance side of it is I handle, with a staff of about 20 here in Buffalo, the placement of coverages for our customers and marketing them to the insurance companies that we represent. I've been with Lolly for 15 years. I had 20 years of experience on the underwriting and claims side with insurance companies like Aetna, Travelers, and Royal. Lolly's a third-generation family business, 3 owners, family members, with 7 branch locations. Each branch location has a minority ownership, where Lolly, the 3 partners, own the majority of each branch. When I started 15 years ago, we had 100 people, and we did about $11 million, $12 million of revenue. We finished 2014 with 8 branch offices in Connecticut, New Jersey, and New York, with 350 people and 60 million of revenue. So we have...
It's doubling the revenue per employee.
Correct. And if you ask our CFO, he drills me on a daily basis what the payroll percentages to revenue, so I know that percentage real good too. The turning point, and this is a third generation family business, the turning point of our business was about when I came on 15 years ago. It had nothing to do with me, trust me. Was we went from being a procurer of quotes, which a lot of insurance agents are, I'll get you a quote, to becoming a resource and being your risk manager. So we went and added, and it was an investment on our part. So our revenue per employee decreased for a short period of time. Having loss control people that would come out to your, for contractors would go out and talk to them at their job site. For a manufacturer would come out and help you with safety and safety culture. We started a specialty division, which now has grown. It started out with $200,000 in revenue. The revenue this year with 4 people was $1.6 million in revenue. Of that 60, we have a benefits division that's one of the largest benefits divisions between here and New York City. Does almost $15 million of revenue. That handles health insurance and rode the wave of the health insurance increases and the benefits and the revenues that came along with it. But with Obamacare, they've gone to a consultative role and a fee role versus commissions, and they started that 4 or 5 years ago, knowing some of the changes coming on. We also have a captive division. So we've gone from where business owners are saying, I'm tired of paying insurance companies their profit and not benefiting from it. So what a captive basically does is you keep your own profit. There's a little risk involved, but for good, well-managed, safe companies, you keep your own profit. That's really as basic as a description as it gets. But as this has developed over 15 years, we have really become risk managers for many of our customers. And we will also sell risk management services. We have people who are not our customers that buy just risk management services. They don't buy an insurance policy from us, but they'll buy risk management services. So that's sort of, and my role in this has increased, as dealing with the placement and dealing with handling all of that goes along with it. My background in claims has also added some interesting dynamics. So really what happens is somebody says, what do you really do? And I said, I solve problems. So that's really what my role is.
So that's that classic move from selling a product to selling a solution.
Correct.
In the insurance business, moving up the value-added chain, growing the business, and also seeing a business that, insurance is a quote-unquote boring business, but it's actually had a lot of radical change in the last 15 years, and we'll talk about some of that as we move on.
Correct.
Thanks. Hi, Duffy Smith. I want to play off a couple of comments that Thomas made already, the unknown heroes of the middle market business, and then the amazing orientation towards solving problems and enabling middle market businesses that we just heard about. I've had the good fortune of being in manufacturing my entire career, and if you look at where I've been, you might ask the question, why couldn't you keep a job? But always been in manufacturing and providing, in my case, consumer goods. And I see service businesses as supporting those kinds of businesses. I think about the foundational role that manufacturing and farming and the like play in an economy. And who do you serve if you don't have an economy that's shored up by those foundational pieces? And so I'm with a company that specializes in financing, buying, capitalizing middle market businesses, and I'm running one of them. And Belmont Meats is probably not well known to you. The founders actually were kidding around one day and wondered what they should call this business, and one of them loved gambling on the horses, and that's where they happened to be, and that's what the name turned out.
Aqueduct Meats just didn't have
It just didn't work. It wasn't a real cachet. I'll tell you what. In 2011, Belmont Meats had sales of about $65 million. Today we'll do about 140. And I've got to inflation adjust that down a little bit, but we're still in the 120 range. Same people, and what we did was enable them. And I love the notion of the unsung or unknown hero of the middle market business. I don't think they're victims. I think they're great entrepreneurs that need access to some of the systems, intel, scale that we can provide as both investors and as managers. I told a story a little bit earlier on about kind of a shrinking market share that Belmont had. Belmont's based in Toronto, services the Canadian marketplace with meat, both the retail grocery trade as well as restaurants across Canada. Does a little bit of business in the US, probably going to do a little bit more. But they had no R&D. And it was paralyzing the company because people didn't see the investment. They didn't think they could do it. They thought it was capital intense, and customers were asking for products that they just didn't have. And we needed it immediately to grow. And so we found a contract R&D firm. And instantly, we had the scope and scale of 60 or 70 PhDs and food scientists around the country working on every manner of food product at our disposal, and a ton of experience. Here's the interesting thing. As we started to work with this firm, which by the way is a middle market firm in size, we found that a whole myriad of Fortune 500 companies were also working with them. And what they were doing was outsourcing the really important research work that they couldn't get out of their own way to do themselves. We've become real familiar with this firm, and a fellow that I used to work with at a former company is one of their principals, so I've got some insights. But what it tells me is the entrepreneurial spirit and the sense of innovation. What created these middle market companies in the first place is still there if we can enable it. And it's what many big companies are trying to get back to. And this is the way, or one example of the way that these firms were doing it from a research standpoint. And believe you me, the names of these food companies are in each and every one of your pantries. Got lots more stories on middle market size cases, but why don't I suffice it to pass the baton.
I thought where you were going, this was a shrinking market. You're saying you're mostly selling in Toronto and it's suddenly becoming vegan or something. No, it's not that good.
No, we're converting.
No, right. But I really think that this theme, I imagine we're going to come back to, is finding, is that actually middle market companies have an opportunity that they probably never had before to leverage world-class capabilities without owning them themselves. And that's a real interesting opportunity. But George, I think they pick up some of that. But first, he's going to tell us a little bit about himself and his company.
Yes, thank you. So first, a little bit about me. I graduated from college a little over 17 years ago. Started a company right out of school. Locally, was supported by folks like Ben Pemberthy and others, and so Buffalo was very, very good to me. Started a company originally, it was called Check.com. It was incorporated by January '98. Also, Al supported, a bunch of folks here supported. But we were a company that Buffalo embraced, even though we were a startup. Started with just a couple guys right out of school. By 2001, I merged the company with another company on the West Coast. It was a way for us to get access to venture capital. In Buffalo, I'd raised a bunch of angel money. And merged my company, came up with the name Synacor, got rid of the two names prior. Agreed to bring in an outside CEO with experience. Guys like Jordan Levy and others got involved at that point, and we started to build what is now known as Synacor. So that's my background. The moment in time, the other question of the case study. We had a lot of fun in the early days of building the company, and I had these great accounts like Major League Baseball and all this fun. It got a lot of press, kind of got me out there. I was able to raise capital. But in 2004, we had a small cable customer. Their name was Susquehanna Cable. Doesn't even exist anymore. Comcast bought them. We came to them with the idea of helping them bring content to the internet. AOL, it was still an AOL era. And this is before TV everywhere and a lot of the things you now hear in the media. But we came to this small cable company. We said, let us help you not just bring broadband to your home, but help you package content, both some free, some paid services, in a way your consumers will understand. We'll bring in big brands like ESPN and Disney into it. And we create this new offering that really hadn't existed. No one else had done it yet. And we really focused on the small cable operator. We got in there with them, we created the experience, we spiffed their call center reps, we helped them create their marketing materials, we invested. We really got in there and helped them bring content to the internet. Fast forward, it was a huge success. 70% of their customers took the content offering for $5 more per subscriber. They straddled the price of Verizon in their market. And we made the cover of multi-channel news and a lot of industry publications, and all of a sudden was really known as the company behind helping to bring content on the internet. And fast forward, I was able to close probably 10 to 20 customers a year for a few years. And really, it was just such an electrifying time. So the lesson learned on that one was it was a moment in time where you just so focus, you create that case study, you really understand it's not just the revenues from that account, not just the margin you're gonna make that day or even that year, but how you're gonna be able to spread the word to the rest of the market and really leverage media to help you get the word out. And boy, did we all of a sudden grow. And you know, today we're a few hundred people. Synacor is a publicly traded company, about 100 million in revenues. We've had a really amazing journey. And yet again today I find ourselves in the same moment where now TV content is coming to the internet and we're one of the companies behind trying to make that happen. And my customers are folks like Verizon and Dish Networks. And you know, I find myself striving for that next case study, the next moment where we can tell the world we've figured out how to do something that everyone else really needs to follow our way. And it's got a huge return when you actually can articulate, capture that case study, and broadcast it to the world.
So when you hit that hockey stick moment, right, that's one cover of the magazine, the phone is ringing off the hook, you've got to scale it, right? I mean, that's a scary, how do you know, you could have blown it. What did you do so that you didn't blow it?
Yeah, there's good problems in life, right?
Yeah.
And
Now,
then
this is
there's
one of the
bad.
bad ones.
It's a good problem to have. Half the people we employ, we actually moved to Buffalo at the time. So we do hear, you know, I'm a huge Buffalo fan, as many of you know. I'm a huge fan of Rochester and Syracuse. My parents are there. So I'm a big upstate, you know, guy growing up in Syracuse. But there are some problems that I don't typically broadcast. One of them is talent, you know, and it's especially in my field, you know, and it's coming along. It's getting better, but especially back then, we were an anomaly of being a tech company and a cloud-based provider of services on the internet. And so half the people we have employed at Synacor there in my office, we actually moved to Buffalo. So that was one of the big things. As we grew, we needed talent. It's not like when you're in New York and you could just go down the street and grab a couple more folks and just try to pay them a little bit more. You know, this was something where you have to move people to Buffalo. Typically the spouse is the issue, not the person who wants the job, you know, whether female or male, it's the same issue. So that was probably the biggest one. And you learn to leverage the community. Folks throughout Buffalo have helped me in the recruiting process. You know, we've got some great things here in upstate New York. And I think you just gotta, one, have that optimism to get those folks to come in and just really hire the best you can hire. Because if we all hire folks that are at the best what they do, they come on quickly. Their ability to be able to learn this new role happens much faster. And I think we just focus on that, it happens.
And clearly also the sheer entrepreneurial confidence to know that, hey, this is going to work.
Yeah, I think.
You know, that's the other thing that's going to help.
Yeah, I definitely constantly, to the entrepreneurs I talk to, wish for the good problems. You know, just hope, you have the problem, those types of problems. So those are fun problems to deal with.
So let's talk about some of the issues. Each of these three guys, and then we want to open it up to hear from you. Each of these three gentlemen has come sort of armed with a topic that he thinks is really crucial, that executives, particularly at mid-sized firms, and if they don't talk about mid-sized firms, I'll say how does this translate to mid-sized firms if we want, really have to wrestle with. And maybe we should go in the same order and pick it up, because the things that really ought to be on the boards, the CEOs, the executive committees plate. That's pretty crucial.
Target, Sony, Home Depot, those names ring a bell. I'm sure we've all had, many of us probably got letters from them that said, you charged something at our store in December of 2012 and your information you provided us has been compromised. The hottest product that Lawley sells right now that we can't even get the policies issued fast enough is cyber liability, privacy liability, protecting information. And it's not just protecting customer information, it's protecting your own employees' private information. So if you
The
don't...
Sony case demonstrated pretty clearly.
Exactly. Some information for many of you who don't know the Target scenario. That breach was not Target. That was their HVAC contractor who had information, access to Target information, and that's how those people got into the Target information. That coverage you can buy, and the results of what happens there, and there's really two scenarios. It's what we call first-party coverage that you buy. And on many of your policies, you probably have a basic coverage, and it's going to give you $10,000 limit. A lot of insurance companies add it to your policies now, but it's very basic, and it covers just first-party, which is going to be notification costs. Okay, it's going to be any fines or penalties that you might have come from the state. Another thing that comes with it is public relations. If you have a breach and your name's going to get put out in the media, you want help doing that. Don't try to do it yourself. These firms, these companies hire independent public relation firms to come in and do it. The second part is the third party part of it. So the liability, if you do cause injury or cause a business that you might have had the information on, to cause a liability claim, to cause damages to them, those are the coverages you need, and legal fees. So if you're going to get sued, you need a limit that's going to cover these legal fees. It's very similar to what employment practices liability was about 15 years ago, when improper, unlawful termination or sexual harassment and the EEOC claims that everybody would get back in the 90s, the coverage was purchased there. It was fairly expensive at the time. That has changed dramatically. The cyber liability, the activity level that's occurred on breaches and claims being put in is causing the coverages, the pricing, to start to pick up. And the coverages, you have to know what you're buying, because you may not be buying third-party coverage and you think you do. And a couple things, like arguments, somebody will tell me, and you can probably answer a little bit more of this, they'll say, well, I have a third-party vendor that does this. Well, that third-party vendor probably also does it for 30 or 40 other people. So if
we have Holly's, I'm sure.
Yeah, look, Cinecore is a client of ours, so we got them covered on that. But if you have 40, if your third-party vendor is having 40 customers, first of all, they might not have enough coverage if there's a really bad breach. And the second of all, how do you know what protections they have? Okay, so that's part of a
Sort of like the other drivers.
a due diligence, but also a contractual issue to make sure you cover. The second one is just pure human error. It's going to happen. Somebody's going to push the wrong button. And for those of you in Buffalo, this happened to a fairly prominent medical firm around here. I'm going to say 9 months ago, a receptionist actually was sending a fax and pushed the wrong button for an attachment. And the attachment was 8,000 medical records for any of us. The next morning, there was an email that was forwarded to me from one of our many plaintiffs' law firms that advertised throughout that said, please send me, if you receive this email, please call us. So, human error. Now, we all talk about how, there's no damages, what did you do? If somebody got your own medical record, how would you feel about it? I'm always asked that. If somebody got your financial record, how would you feel about it? If somebody got your social security number, you're not going to be real happy about that because somebody could do something with it. Those are the claims that are going to come out and they're going to develop, and that development is happening as we speak.
So go back to your earlier theme of moving from selling products to selling solutions. So you got a hot product. You got Duffy Smith here in the meat business. The best insurance policy is the one you pay for and never have a claim for. Are you starting to see best practices that mid-sized companies can learn or that they're applying in defense so that the receptionist doesn't do this, that, and the other? I mean, what's the advice beyond trying to buy an insurance policy? What's the risk management advice that you think is most critical for executives that they're not thinking about it? Is it maybe just to think about it? What's the most important thing they should do?
Exactly what you just said. You have to accept that you have that risk, okay? Then there's two ways to do it. You avoid the risk, okay? I'm not gonna store personal information, and my HR people, maybe I'll outsource that. And again, you gotta make sure you have that coverage on the outsource.
So in other words, there's no point in denying the monster's under the bed. The monster's under the bed. First thing is to acknowledge it, figure out what
The biggest buyers right now have been institutional buyers. Colleges, universities, schools, and also some of the service providers, law firms have, and accounting firms, obviously they have information, but not physicians firms. It's almost scary. And they don't pay a lot for it. And there's ways to prevent, and from a technical standpoint, that's something that we are trying to develop, is how to protect customers from that and advice. Right now, the insurance companies that write that, and they're fairly limited. ACE is one that's very well known. Chubb is another one. Those are two. They'll provide you information and some risk management on the behalf, but they're going to want to write your policy too.
So let's move to Duffy, but let's hold that up as one thing that probably half of you guys aren't even doing, are sort of pretending doesn't exist, and shouldn't pretend doesn't exist.
As a middle market business person, one of the things that we should make a condition of engagement with any supplier of goods and services is what's the value add. I don't just want to buy insurance. I want to buy a total risk management package. I want you training me. I'm not the expert, you are. So what is it about how I use the goods and services that you provide that make me a better player? And I can tell you, the big guys leverage their suppliers that way. There's no reason why on a dollar for dollar basis we can't do the same. We don't have the HR expertise. We don't have the risk management expertise. You mentioned it. It's a great point, but the relationships between goods and services providers in the middle market, I think a lot of times remains at a transactional level as opposed to a partnership level, and really digging into that. My big concern, I hope I'm not too existential, but I'm real concerned about the economy in general and the declining role of manufacturing. And I forget exactly what year it was, but it was probably within the last 20 that China exceeded the United States in terms of gross domestic product associated with manufacturing. And in about 1955, services were a bigger percentage of the gross domestic product in the United States. When you spend $1 in manufacturing, you get $1.37 to $1.40 return. There's no other sector that drives a multiple like manufacturing, and it is the receiver of all these other services. We've got to focus on things that way. And the point I made earlier on about the kind of the cauldrons of innovation, the smaller, more entrepreneurial, more nimble companies are where it's at if we can enable them. And that brings me to the second concern I have, and you started to touch on it, and that's people. Some of these companies, they've reached the end of their capital, or they haven't researched or haven't been able to research their market or don't know how. So they've painted themselves into a little bit of a box. Many don't do any succession planning or development planning. How can we help that? How can we grow them? How can we show them, help them see how much bigger this idea that's been successful can get, and then invest in people? And I'll tell you what, when you walk up to a company that hasn't been invested in for some time and start real, solid, authentic investment, magic happens. Absolute magic happens. So those are the two key. I know I'm staying at a fairly high level. Let me give you a real neat little example. I was in the refining business with a company called Imperial Sugar for a number of years. And they had aggregated more refineries than anyone else, and they became the biggest national refiner of sugar, both cane sugar and beet sugar. In the commodity business, you tend not to invest in assets very much. And some of these facilities were well in excess of 100 years old. They've got to run seasonally. They've got to run. And the lack of sophistication of some of these operations, which were all acquired independently, had them ensure they would run by having storerooms full of spare parts. And so, you know, the balance sheet looks terrible. And we developed what we call the white glove test, testing how long it had been since this motor or this drive or this spare part had been sitting around. But we taught people about preventive and predictive maintenance. And here's a neat story. These big industrial drives and vibrators and the refining equipment has an awful lot of motors and drives and gearboxes. We taught them how to measure vibration. And there's some equipment that will help you predict whether something will run for another 6 or 8 months or not run for another 6 or 8 months, make it through the season or not. So instead of just replacing at whole scale, keeping spare parts galore, they learned how to do vibration analysis and save a ton of money and had fun doing it. So here was one of the examples of fun. On a Saturday morning, about the middle of beet sugar season, I happened to be in the neighborhood of one of the facilities, and it was in Colorado. And they tried to keep me from going to the facility, and I couldn't figure out why. But we got within about a mile of the facility, and I found out there was over 30 pickup trucks and guys with their boats with outboard motors lined up at the facility. Well, they'd done all their PM work with the vibration analysis, and now what they were doing is balancing the propellers on Evinrude's, Johnson's, and Merck's. But you know what? An amazing cultural change to turn great people, regular mechanics and torque wrenchers into much more sophisticated and applied business people. This company was, by definition, exceeded the middle market size when you put them all together. But not one of these facilities was anything but a pure middle market with a ton of innovation and a ton of spirit going on. And we just enabled the people with exposure to some different technology. And that's just an absolute key.
George, pick that up, but this, I just want to leave you with one factoid. The Fortune 500 was started in 1954, and you will be amused to know that at that time, 4 of the 10 biggest companies were meat packers. Swift and Armour and Hormel and so on and so forth, and now you couldn't find a meat packer in the Fortune 500 if you look for it, although you might find it buried in some large conglomerate. But George, what's your passionate issue? We're running a little low on time, so we're going
I won't be
to do
too
this,
long.
and then we may have our Q&A session. We have a quick little presentation, and then we may have our Q&A session with some tacit knowledge sharing accelerant, which you can buy at the back.
Okay, the topic that I wanted to, that I'm very passionate about is how really cloud services for mid-market companies is really going to sort of grow and really change, and I think create more and more companies. So behind the scenes, my company, Cinecor, you see the names of these products, TV everywhere and email and all these services. What they're all done is we take software, we put it on a server. Our servers happen to be in Atlanta and Columbus and a few other places. And we're powering services on behalf of Verizon. We're powering services on behalf of Dish Networks. Consumers have no idea we're here in Buffalo, New York, building software, hosting it around the world. Some customers now in Latin America. Some of my friends' companies in Buffalo, Advanced 2000, Campus Labs, others. We're employing thousands of employees in Western New York, and if you add in there Rochester and Syracuse, there'll be a bunch more names. And we're creating a lot of jobs. And I came back from CES this year, Consumer Electronics Show, and I've been going to it now for I think 13 or 15 years, however long it's been, a while. And I came back just thinking, oh my God, we're just in the beginning. The amount of technologies that are going to change manufacturing companies, the amount of technologies, everything from building new machines to new things, and how everything's going to be wired and how everything's going to be powered. If each of those CEOs and each of those entrepreneurs understand how they can differentiate, how they can come at the market in a different way, how they can be located anywhere in any of these cities like the Buffaloes of the world and change their sector, and we're starting to see examples. I mean, the companies I mentioned, I can't give their revenues because they're private, but I have, Advanced 2000, Hover Networks, so I'm not just talking about my company. These guys are growing, they're employing. One of them will go from a small cap to a mid-sized cap company overnight. And it's just fascinating to take, in their case, telephony, which has been a pretty old business, and serving customers around the world and growing like crazy, having the problems of hiring, which is a great problem, right? So I think when I look out at all these different sectors, and I look at how technology, how cloud services, how you can create some unique advantages, whether it's helping your distributors or helping your end consumers get more, as we all get Nest into our house, which I hope you're all playing with these technologies, and if you start to see how older things are now being wired, I think it just starts to show how I think we're really just in the beginning of how cloud services will change the economy.
And part of the thing here for mid-sized companies and small businesses too is if I can buy software by the drink or buy terabytes by the drink or teraflops by the drink, I don't need to build a big glass house. I can rent it. I can put on my income statement what I used to have on my balance sheet, and I can compete with Procter & Gamble. I can compete with the big guys without, I can I can rent a world-class capability and big playing field leveler in all my back office functions, in a lot of my analytics, consumer-facing functions, and a lot of my logistics distribution functions, right?
Even Netflix, who has a lot of money, decided to put everything on the Amazon cloud. And even with all their cash, and they spend a lot of money every month on programming and other things. And
it's more money left over for Kevin Spacey and Robin Williams.
But without a doubt, any one of us can launch a product that would have costed us probably, $3 to $10 million in hardware, terabytes of data. What would have cost me something just a few years ago. Now I can spend under $1 million, maybe a couple $1 million, and just rent the rest. And that's just unbelievable. So when you look at that happening in so many different ways across so many different sectors, I really think we're just in the beginning.
Do you think, just one quick thing, and then I know we'll move on. As you look around at your customer base, are there industries that are slow to get the cloud? Or are there some people that are really more advanced and some people who ought to be jumping at it that just haven't caught on yet?
Well, there's risks out there. We heard a little bit about some of them, and there's concerns out there that I can't partner with somebody, like whoever Target was partnered with. So without a doubt, the risks and the fears need to be addressed.
The defense contractors can't, for example. I don't think they can do anything on a
But then, we'll learn more about private clouds shortly, and, whenever there's a problem to solve, there's some entrepreneur out there that's gonna solve it, right? So we'll just see more and more.
Watching our time, let's just thank these three guys and we do have some time for Q&A? Okay, because all right, fine, we'll moderate some I will immoderate some Q&A. Thoughts, questions, challenges, attacks, comments? Somebody be the first. It's always the first. Somebody be the entrepreneur of the questions. Sam, be the entrepreneur of the questions. Okay. I have one, but I'd rather hear from you guys. You've heard enough from me.
Dan, do you want to?
Yes. Yeah.
George, you're the closest to the startup phase. Startups get a lot of attention. Did you ever cross your mind, I want to be stuck in the middle market, or are you happy to be at $100 million from the startup phase?
I don't think entrepreneurs are ever happy. Everyone I've met, you have a drive, and so today I'm sitting in the mid-market chair. I would definitely be hoping someday to be sitting on, another panel someday, being one of the large cap companies. But along the way, we'll enjoy the ride, hopefully from 100 to wherever that tipping point is. But I think. Like a lot of guys and gals out there, you just want to get to the next level.
Yes, ma'am.
So I think one of the reasons that you don't hear much of economic development or other policy folks expressing your needs is because the breadth and depth it's overwhelming, frankly. How do we qualify what you want? So I guess my question is, what would you want your community, your public policy, your public funding to do for your?
Let me take a first stab and then guys comment on it. One of the things that we've noticed is that if we go around and talk to chambers of commerce, they often have programs for the large corporates that pay the biggest dues, and they have programs for small companies that make the most noise or have a lot of and have the most voters. But the middle tends to be forgotten. There are a few that are exceptions, and one that has been around for some time is the Greater Cleveland Partnership, which caught on to this, I think partly as Cleveland was rebuilding when after the manufacturing industries in Cleveland died, something like 25% of all jobs in Cleveland disappeared. And so Cleveland did a lot of business development thinking. But they do a really good middle market program, a half-day program every year with, we usually come and talk about it. They bring some private equity people because private equity plays a very important role in the middle market, as you know. They also bring some faculty from Ohio State to talk about talent management, innovation, and other kinds of issues. And they do a program. They also have a partnership with Cranes in Cleveland and regularly publish stuff. So they have helped create a community where people can talk. Because most companies don't identify, maybe if they're small, they identify themselves as small. But mostly they say, I'm in Cleveland, I'm in Buffalo, I'm in the auto industry, I'm in meat, I'm in what they identify by industry or geography, but they don't often recognize that there are specific issues having to do with scale. So part of it is just getting these organizations to recognize the gap. And when you point it out to them, they say, gee, you're right. And then, we're now seeing action in Dallas and Chicago and Cincinnati and Milwaukee and a few other places where people are recognizing there's some stuff we can do here that would be of value, that would bring policymakers together. Because again, also, there's no photo op for the mayor if the guy with the factory at the end of the road adds 20 more people to his payroll. And so bringing some, I was telling you earlier, because I was at this meeting with Governor Kasich talking to the Chamber of Commerce of Ohio. He kept talking about small business and entrepreneurs, all of which I love. But, I wanted to grab him and say, hey, Gov, you want to look at job creation? It's not there. And so bringing that awareness out is one thing, but I don't know, what do you guys think? You're on the ground living it.
Part of the answer to that is it depends. I think if you think about the middle market and then think about us as enablers, we look at companies and we look at everything from the people that run them and their sense of leadership and strategy, developing people. We look at their strategy, we look at their balance sheet, we look at their market. How do you want to grow? What are the barriers to growth? And then you can start to look at the kinds of programs that are available or not available, but it's not the same everywhere. So I think it depends on how we see enabling them, teaching them things that they don't know, showing them and introducing them to people and programs that they don't have or don't think they can have. There's a huge sense of have-not, in my experience, in the middle market, but it depends on the specific needs of the company. But I think, again, if we think of ourselves as enablers, great people, the unsung heroes, the unknown heroes of this economy, really, what's got them stalled out and what do they need? What is it that they don't think they can get that we can help them with? And then I think you approach the programs.
You know, it's interesting, there's a very robust academic finding that shows that when companies are bought by private equity firms, their investment, their capital spending tends to go up and their results tend to go up too. Now that's not just because private equity firms are virtuous and good guys. Sometimes it's because it's been bought by somebody who's been starved of the business because he's gotten old and finally he sells it raw because his son or daughter doesn't want to take it over. So they may have not been investing in the business, just as you were telling the story with the sugar company. But there is a certain amount of knowledge that sharing of knowledge and bringing of expertise to people who have been so heads down running the business can make a huge difference. Yeah. One more or no time? All right, well, let's wrap it up. I want to thank these guys again. This was a great session. Thank you for your questions.
Tom, thank you very much. And George, Duffy, and Dan, assure me you are not the unknown and forgotten heroes of the American business economy. We truly value each and every one of you, even though I only had an investment in one of you, but that's okay. Tom mentioned to us earlier that the middle market companies, they're bigger than small and smaller than big. So think about that. There was a $10 million to $1 billion gap, right? So, and he said they're 31-year-old privately held companies. You know, there's a lot of those up and down Walden Avenue, you know, Broadway as you're heading out towards out of the city. It's an incredible. Our speakers talked about revenue growth, job growth, capital investment plans. Dan specifically talked about how his company's changed over 15 years. The move to cyber insurance or risk management, and also one of our companies, Liaison, which we sold like a couple years ago, has done a lot in helping you change your business. And that all feeds into what Tom in one of his reports said. 74% of the companies project a positive change in revenues, and that's directly attributable to these companies' willingness to change and adopt new products and services. And we witnessed that through what Wally was talking about. Duffy, I don't believe you're in the meat business because I invested in a meat business company. It was a guy with a gold chain, an open shirt, drove a Cadillac, named Anthony from New Jersey.
He's faking that Canadian accent.
So you don't quite fit that mold. But I lost all the money on my deal, and it sounds like you're going terrific. But Duffy also talked about using contract R&D and thinking outside of the box, and it fed into what Tom talked about, and that 68% of the middle market companies will invest capital to increase jobs, equipment, and acquisitions. And that's critical to the success of these middle market companies. And George, we invested in his company when he had 20 employees. He's now over 300 now. It's been an incredible success. I will make one small correction though. His first customer, I don't believe was Susquehanna. I think it was called Grande because they were an imminent customer that was going to sign 30 days after we made our investment. I don't think you ever signed them. It took a few years. I think it took many a few years. But George did hire a lot of people, and it was a tremendous success story locally. And Tom's report will also show you that these middle market companies have an 81% confidence level in their local economies and will, definitely add jobs. So it's critical for these companies and in what they're doing in the local economy. And in that regard, it's the efforts of the Business Council of New York State and the Buffalo Niagara Partnership, two of our lead sponsors, which help contribute to that local confidence in the local economies. And the last the closer is the effect of Launch New York. Not only is the impact on these middle market companies, it's the startup companies, and Launch New York is going to help evolve a whole bunch of new startup companies that will at some point be $10 million companies and will be part of this middle market sector. So thank you very much, gentlemen. UVANY is very glad to have you here this evening. Please enjoy some networking and some more cocktails. Thank you.